I see the cracks forming before most people even realize the ground is shifting beneath them. Not the cracks in the stock market you're watching on your phone every 5 minutes. Not the ones in crypto or tech or whatever meme stock is trending on Reddit this week. I'm talking about something much deeper. Something that, if it breaks the wrong way, won't just correct your portfolio. It will freeze the global economy solid. And here's what keeps me up at night. You're probably looking in the Won wrong direction. Right now, there's a silent time bomb ticking in a corner of finance that most retail traders have never even heard of. It's called the private credit market. Sounds boring, right? Sounds like something your accountant worries about, not something that makes or breaks your trading account. That's exactly why it's dangerous. The most destructive forces in financial history never announce themselves with fireworks. They build up silently in the shadows while everyone chases the shiny object. I've seen this movie before. Back in 2008, I had a front row seat to the collapse. I watched as a relatively small crack in the subprime housing market, a market most traders ignored, shattered the global banking system and wiped out 40% of the world's wealth. And what scares me today is that I'm seeing the same ingredients again, the same leverage, the same opacity, the same complacency. Here's what's happening. Over the past decade, trillions of dollars have flowed into private credit funds. These are funds that lend money to companies, medium-sized businesses, leveraged buyouts, commercial real estate projects. But unlike banks, they're not required to hold massive cash reserves. They're not regulated the same way. They promised their investors high yields, and for years they delivered. But there's a catch that most people don't understand. When you invest in one of these funds, you can't just cash out whenever you want. You're locked in. And the companies borrowing this money, they're often the riskiest players, the ones who couldn't get traditional bank loans because their balance sheets were already stretched too thin. So you have a system where risky borrowers owe trillions to funds that can't handle a sudden rush of withdrawal requests, and those funds owe their returns to pension funds, endowments, and yes, even your 401k behind the scenes. It's a house of cards and the fan is starting to spin. The Wall Street insiders know this. The institutional money is already quietly repositioning. They're pulling capital out of the riskiest private funds. They're building cash positions. They're hedging in ways that most retail traders don't even have access to. And meanwhile, the average person sitting at home with a trading app is completely oblivious, still chasing the next big thing, still believing that diversification means owning 20 different tech stocks. I was that young trader once. I remember ignoring the bond market completely because I thought the action was in equities. I thought I was smart because I could pick winning stocks. And then the credit market seized up and I watched my gains evaporate overnight because I didn't respect the plumbing. The plumbing is what matters. The plumbing is what keeps the whole system running or brings it crashing down. And right now the plumbing is clogged with debt that nobody fully understands. So why aren't you hearing about this everywhere? Because it's not clickable. It's not a 5-minute YouTube explanation with a thumbnail of a rocket ship or a crash graph. It's complicated. It requires thinking beyond the next earnings report. And honestly, most financial media doesn't talk about it because they're selling you action, not understanding. But here's the truth. The traders who survive the next downturn won't be the ones who made the most money in the boom. They'll be the ones who saw the risk coming and positioned themselves accordingly. They'll be the ones who understood that in a liquidity crisis, cash isn't just king, it's oxygen. And if you're breathing without knowing where your next breath is coming from, you're already in danger. This channel, Dimonomics, exists for one reason: to give you the lens that most traders never develop, the lens that sees around corners, the lens that understands the system, not just the ticker. I've spent 40 years in this business. I've sat in the room when the world's financial leaders panicked. I've made the mistakes that cost me money and the decisions that saved institutions. And I'm telling you right now, what's brewing beneath the surface matters more than any stock pick you'll make this year. If you take 10 seconds right now to hit that subscribe button, your future self, the one who doesn't panic sell at the bottom, the one who sleeps peacefully while others lose sleep, will thank you. I know that feeling. I've lived it. And it's worth more than any trade you'll ever make. Because here's what most people don't understand yet. This isn't about predicting a crash. It's about understanding the machinery. The private credit market is just one gear in that machinery. But when one gear seizes up, it takes others with it. The pension funds that invested heavily in private credit, they start selling public stocks to raise cash. The banks that lent to the private credit funds, they tighten their lending standards, making it harder for normal businesses to operate. The businesses that can't borrow, they stop hiring, they stop expanding, and suddenly what started as a problem in an obscure corner of finance becomes a problem in your neighborhood, in your job, in your grocery bill. That's how contagion works. That's how a small crack becomes a global recession. And by the time you see it in the headlines, it's already too late to prepare. I'm not here to scare you. I'm here to wake you up, because fear paralyzes, but awareness empowers. And right now you have a window, a narrowing window, to look at your own financial position and ask the hard questions. Do you actually understand where your money is? Not just what ticker it's under, but what's backing it. What happens if the credit markets freeze for 60 days? What happens to your trading account if margin requirements double overnight? What happens to your job if your employer suddenly can't borrow to meet payroll? These aren't hypotheticals. These are the questions the CEOs are asking in their boardrooms right now. And the gap between what the professionals are preparing for and what the average person is ignoring has never been wider. So here's where we stand. You now know about the ticking bomb. You know it's in the private credit market. You know it's connected to your 401k, your pension funds, and the stability of the companies you might work for or invest in. But knowing about the bomb is only the first step. The real question is, how does it actually detonate? How does this abstract risk become a very real loss in your brokerage account? That's what we need to understand next, because the transmission mechanism, how the problem moves from their problem to your problem, is where most people get blindsided. And trust me, the path it takes will surprise you. It won't look like 2008. It won't look like 2020. It will look like nothing you've seen before. And if you're expecting the old playbook, you're going to get crushed. So now you know about the bomb. You understand that trillions of dollars in private credit are sitting out there in this loosely regulated shadow banking system, borrowed by companies with shaky balance sheets, funded by vehicles that can't handle a rush of withdrawals. But here's where it gets personal. Here's where that abstract risk stops being a Wall Street problem and starts showing up in your brokerage account, in your retirement statement, in your ability to sleep at night. And this is the part most people get completely wrong, because they assume the transmission is simple. They assume they'll see it coming. They assume a crash looks like 2008 or 2020. It won't. Let me walk you through how this actually unfolds, because I've seen the mechanics up close. When the private credit market starts to crack, it doesn't make headlines at first. It makes margin calls. The institutional investors who parked money in these funds, pension funds, endowments, sovereign wealth funds, they start to get nervous. They hear whispers. They see redemption requests getting denied or delayed. And their first move isn't to panic publicly. Their first move is to raise cash wherever they can. And where do they raise cash? In the most liquid markets they have access to. That means public stocks. That means your stocks. So suddenly, without any news about Apple or Microsoft or whatever you're holding, there's selling pressure coming from institutions that need liquidity, because their private investments just froze. You wake up one morning and your portfolio is down 3% and you have no idea why. That's the first wave. Then comes the second wave, and this one hits closer to home. The banks, and I say this as someone who runs one of the largest, start tightening credit. Not because we want to, but because we have to. When the private credit market seizes, it creates a domino effect through the entire lending ecosystem. The companies that borrowed from those private funds, they can't refinance, they can't get new loans, so they start cutting costs. That means layoffs, that means freezing expansion plans, that means reducing inventory orders, and the companies that supply them, they suddenly have less revenue, their earnings drop, their stock prices follow, and now the selling pressure isn't just from institutions raising cash, it's from fundamentals deteriorating in real time. This is the phase where the market stops caring about narratives and starts caring about survival. And if you're still trading based on PE ratios and technical patterns, you're going to get run over. But here's the part that really keeps me up at night, the part that most retail traders haven't even considered. Remember those pension funds I mentioned, the ones that invested in private credit? They're not just Wall Street players, they're your teacher's retirement fund, your local government employee's pension, your union's nest egg. When those funds take losses or get stuck with illiquid holdings, they have to make up the shortfall somewhere. That means higher contributions from employees, that means reduced benefits, that means your parents' retirement might get squeezed, even if their portfolio looks fine on paper. And when people feel their retirement security slipping, they stop spending. The consumer, who has been the sole engine keeping this economy running, finally taps out, and that's when a financial problem becomes a human problem. I think about this constantly in my role. Every morning I walk into that building and I ask the same question: what are we not seeing? What risk is hiding in plain sight? And right now the answer keeps coming back to this web of interconnected leverage that nobody fully maps. Because here's the dirty secret of modern finance. The regulators don't have visibility into private credit the way they do into banks. The funds aren't required to report their holdings the same way. So we're flying partially blind, guessing at the concentrations, estimating the leverage ratios, hoping that the system is resilient enough to absorb a shock, and hope is not a strategy. I learned that in 2008. Hope is what kills you. If I were sitting where you're sitting right now, if I were 30 years old again, building my future, trying to trade my way to something better, I would be asking myself one question above all others. What happens to my plan if the music stops? Not if the market dips 10%, not if we get a normal correction, but if the credit markets truly freeze for 60, 90 days, if companies can't borrow, if margin requirements double overnight, if the liquidity that we've all taken for granted for 15 years simply evaporates, because that scenario isn't alarmism. It's happened before, it will happen again, and the only people who survive it intact are the ones who prepared while everyone else was still dancing. And the psychological trap here is what we call anchoring. And you look at a stock that's down 20% from its high, and you think it's a bargain because you're anchored to that high. But in a credit crisis, down 20% can be just the beginning. Stocks can fall 60, 70% and stay down for years while companies struggle with debt they can't refinance. The value isn't determined by what it used to trade at. It's determined by whether the company can survive the next 12 months without access to capital. And most traders never bother to check that. They look at charts, not balance sheets. They look at momentum, not debt maturities, and that's how they get trapped. I watch this happen every cycle. Smart people, good people, people who work hard and save diligently, they get caught because they're looking in the wrong direction. They're watching the Fed, watching earnings, watching the news, and all the while, the real danger is building in a part of the market they never even thought to examine. That's not their fault. The system is designed to be opaque. The complexity is a feature, not a bug. But understanding that complexity, seeing through it, that's the difference between being prepared and being surprised, between sleeping well and staring at the ceiling at 3 a.m. wondering where the money went. So now you know the bomb and you know the transmission. You understand how private credit stress becomes public market selling, how institutional liquidity needs become your portfolio losses, how frozen lending becomes layoffs, becomes spending cuts, becomes earnings collapses. But knowing the mechanism isn't enough. The question you have to answer tonight before you go to sleep is, what do you actually do about it? Because awareness without action is just anxiety, and anxiety won't protect you when the margin calls start flying. So we've walked through the bomb and we've traced the wires back to your portfolio. You understand now that this isn't some abstract Wall Street problem. It's a mechanism that will transfer wealth from the unprepared to the prepared when the liquidity tide goes out. And make no mistake, the tide always goes out. The question isn't if, the question is whether you'll be standing on dry land or caught swimming naked when it does. Let me tell you what I would do if I were in your position, not as the CEO of JP Morgan Chase, but as someone building their financial future from where you're sitting right now. Because I've been there. I started with nothing. I made the mistakes. I learned the hard way that preparation isn't about predicting the future. It's about surviving whatever future shows up. And the first thing I would do tonight is audit my liquidity. Not my returns, not my winners, my liquidity. I would look at every dollar I have and ask, if the market's closed for 60 days and I lost my income, how long could I survive? 6 months, 12 months? If the answer is less than 12, I would start moving money into actual cash or cash equivalents right now. Treasury bills, money market funds, high yield savings accounts, things that don't fluctuate with the stock market, things I can access without selling into a panic. I know that sounds boring. I know cash feels like it's losing value to inflation, but here's what I've learned over 40 years in this business. In a liquidity crisis, cash isn't just an asset, it's the only asset. It's the ability to buy when everyone else is selling. It's the ability to pay your bills without being forced to liquidate at the worst possible moment. It's the difference between being a victim of the crisis and being an opportunist during it. The investors who made fortunes in 2008 weren't the ones who saw it coming. They were the ones who had cash when everyone else was desperate. They bought quality assets at 50 cents on the dollar from people who had no choice but to sell. That's the game. That's always been the game. The second thing I would do is look at my holdings through a completely different lens. Not what's going up, but who's going to survive. I would go through every company I own or am considering and ask the hard questions. How much debt do they have? When does it mature? What's their cash position? Can they survive 18 months without access to credit markets? Because in the scenario we're talking about, revenue will drop, margins will compress, and companies with high debt and low cash won't make it. They'll dilute shareholders, cut dividends, or simply go bankrupt. The quality companies, the ones with fortress balance sheets, low leverage, and real cash flow, they won't just survive, they'll thrive. They'll acquire their weaker competitors. They'll gain market share. They'll emerge stronger on the other side. Those are the ones you want to own, not the high-flying growth stories with no profits and burning cash. The boring, durable, boring companies that have been around for decades and will be around for decades more. I think about this constantly in how we run JP Morgan. We maintain a fortress balance sheet, not because we're pessimistic, but because we're realistic. We know storms come. We know we can't predict their timing or intensity, so we prepare for the worst while hoping for the best. That's not cowardice. That's wisdom. And your personal finances deserve the same approach. Build your own fortress, not with complex derivatives or exotic strategies, but with the oldest tools in the book, cash, quality assets, and time. And the third thing I would do is probably the hardest. I would stop trying to be a hero. I would stop trying to catch the exact bottom or time the perfect entry. I've been doing this my entire adult life, and I still can't do that consistently. Nobody can. The people who tell you they can are selling something. Instead, I would dollar cost average into quality positions over time. I would build positions gradually, accepting that I might not get the absolute lowest price, but ensuring I don't get the absolute highest either. I would focus on accumulating durable assets at reasonable valuations, and then I would do the hardest thing of all, nothing. I would let time do the work. This is where the psychology gets really tricky, because doing nothing feels wrong. It feels passive. It feels like you're missing opportunities. But the greatest enemy of good returns isn't bad markets. It's activity. It's the constant need to do something, to trade, to optimize, to beat the system. And the system doesn't want to be beaten, and the system wants you to chase, to react, to exhaust yourself with motion that goes nowhere. The investors who win over the long term aren't the busiest. They're the most patient. They understand that wealth is built in the waiting, not in the trading. If I could go back and tell my younger self one thing, it would be this. The market will always give you another chance. There will always be another opportunity. You don't have to catch this one. You don't have to be in the trade that's working right now. What matters is being there for the trades that work over the next 20 years. And you can only be there if you survive the downturns in between. That's the whole game. Survival plus patience equals compound interest. And compound interest over a long enough timeline is how ordinary people build extraordinary wealth. So here's what I want you to do tonight. Not tomorrow, not next week, tonight. Pull up your accounts. Write down everything you own. Next to each position, write down two things: the company's debt-to-equity ratio and their cash position relative to their market cap. If you don't know those numbers, look them up. If you can't find them, that's a red flag. Then look at your cash position. Calculate how many months you could survive if your income stopped and your investments dropped 30%. Be honest with yourself. If the number scares you, start fixing it tomorrow morning. Sell something, build the cash, make the boring, disciplined choice that your future self will thank you for. I've sat through more crashes than I can count. I've seen fortunes made and destroyed. And the one pattern that never changes is this. The people who prepare feel fear like everyone else, but they don't act on it. They don't panic. They don't sell at the bottom. They don't lay awake wondering if they'll make it. They rest easy because they know they've built something that can withstand the storm. That peace of mind, that unshakable calm in the face of chaos, is worth more than any return you'll ever generate. It's the real wealth. Everything else is just numbers on a screen. This is Jamie Dimon. This has been Dimonomics. Don't just trade the market. Understand it. Don't just hope for the best. Prepare for the worst. And remember, the goal isn't to predict the future. The goal is to build something that no future can destroy. Go do that. Your future self is waiting.